September 15, 2008. A bank with $600 billion worth of assets announced it was going into administration. Bankers who had gone into work as normal found themselves returning home carrying their possessions in cardboard boxes. What followed was the longest and most significant bankruptcies Wall Street and the world has ever seen. Lehman Brothers, the fourth largest investment bank in the USA, buckled under the weight of the global financial crisis that had been carving through Wall Street for a year, proof that even the biggest banks weren't untouchable. Livelihoods were lost and gained on this pivotal moment for the US and global economy. The story of Lehman Brothers is one of unbelievable success, but also a tale that ends with the biggest corporate failure we've ever seen. The start of our story takes us all the way back to 1847. Henry Lehman, a young Jewish man from Bavaria who left his home behind and moved to America. Settling in Montgomery, Alabama, Henry decided to open a dry goods store. In 1847, he was joined in Montgomery by his brother, so the store became H. Lehman & Bro. In 1850, their youngest brother Mayer arrived in town, and the name was changed to simply be Lehman Brothers. During the 1850s, the brothers began trading in goods, mainly cotton to begin with, after people began paying them cotton instead of cash. They realized this was a much more lucrative pursuit than running their store, and after Henry passed away in 1855, the two remaining brothers decided to make trading the sole focus of their operation. That was followed by a move to New York, a more suitable base for a trading business than Alabama. A few short years later, and the cotton trading business would be decimated by the U.S. Civil War. For Lehman Brothers to continue, a new line of business would be needed. In 1870, that opportunity presented itself, and the firm was one of the founders of the New York Stock Exchange. In 1887, they became members of the exchange as they transitioned away from commodity trading into more financial dealings. As the century turned in 1899, Lehman Brothers took on investment banking activities, making its first public offering for the International Steam Pump Company, and the rise of this U.S. financial institution had truly began. Emanuel's son Philip Lehman took over the business in 1906, and this signaled the end of the company's commodity trading operation. During that era, Lehman Brothers forged significant partnerships and ventured into groundbreaking new endeavors. One of the notable collaborations was with Goldman Sachs & Company, a partnership that would prove pivotal in bringing the General Cigar Company to the market, closely followed by the iconic Sears, Roebuck & Company. Following Philip Lehman's retirement in 1925, the mantle of leadership was passed to his son, Robert "Bobby" Lehman. Bobby's stewardship of the firm proved instrumental during the tumultuous times of the Great Depression. Lehman Brothers adeptly navigated the capital crisis by focusing on venture capital initiatives while patiently awaiting the recovery of the equities market. In 1924, a significant milestone was passed when John M. Hancock became the first non-family member to join the firm. This was swiftly followed by the inclusion of Monroe C. Gutman and Paul Mazur as partners in 1927. By 1928, Lehman Brothers had established its headquarters at the renowned 1 William Street location, solidifying its presence in the financial world. During the 1930s, Lehman Brothers began investing in more pioneering endeavors, playing a pivotal role in underwriting the public offering of Dumont Laboratories, one of the first television manufacturers. Additionally, the firm contributed to the financing of the Radio Corporation of America, RCA, moving them into the world of communications for the first time. Lehman Brothers also looked towards the rapidly expanding oil industry, providing vital backing to companies such as Halliburton and Kerr-McGee. This period of growth and investment into new and exciting sectors continued until 1969, when the company had to sadly bid farewell to Robert Lehman, who had been at the helm for 44 years. With his passing, the last direct link to the Lehman family's active involvement in the partnership was severed, signaling a new chapter in the firm's journey. In 1973, amidst a period of economical turbulence and uncertainty, a beacon of hope for the bank emerged in the form of Pete Peterson, a seasoned leader who had held the positions of chairman and chief executive officer at the Bell and Howell Corporation before moving to Lehman Brothers. Peterson was tasked with salvaging the firm, and his appointment was an important one. Under Peterson's astute leadership as chairman and CEO, Lehman Brothers set out on a strategic path to regain its footing in the financial markets. In 1975, they acquired Abraham & Company and underwent a merger with Kuhn, Loeb & Company 2 years later. This merger resulted in the formation of Lehman Brothers, Kuhn, Loeb Incorporated. This was the moment Lehman Brothers became the country's fourth largest investment bank, trailing only Salomon Brothers, Goldman Sachs, and First Boston. Peterson's tenure at the helm brought about a remarkable turnaround. The firm evolved from grappling with significant losses to achieving 5 consecutive years of record profits, boasting a return on equity that ranked among the highest in the investment banking industry. Lehman Brothers, under Peterson's guidance, had not only weathered the storm, but had emerged stronger and more prosperous than ever before. However, in the early 1980s, trouble would strike again. Internal tensions had begun to brew between the investment bankers and traders at the firm. In response to these evolving dynamics, Peterson smartly promoted Louis Glucksman, the company's president, COO, and former trader, to be his company's CEO in May 1983. Glucksman brought about some real changes within the organization, but these changes did not have the desired effect of reducing tensions, instead making them worse. Coupled with Glucksman's distinctive management style and yet another downturn in the financial markets, a power struggle began within Lehman Brothers. Ultimately, this led to the end of Peterson, leaving Glucksman as the sole CEO. The fallout from this power struggle was felt across the company. Disheartened bankers who had grown disillusioned during the upheaval started to walk away, resulting in a significant loss of talent at the firm. Stephen A. Schwarzman, chairman of the firm's Mergers and Acquisition Committee, candidly reflected on this moment, describing it as extremely competitive and noting that it had become dysfunctional. As the company grappled with the consequences of this internal disintegration, Glucksman found himself under pressure to sell the firm. Lehman Brothers, once an exemplar of financial prowess, was now facing the possibility of a merger or buyout and ceasing to exist as a standalone business. In 1984, that possibility became a reality. Lehman Brothers became part of Shearson American Express, a securities company under the American Express umbrella. This acquisition also marked a shift towards brokerage services rather than investment banking, setting the stage for Lehman's evolution under new ownership. The acquisition was completed for a sum of $360 million, aligning the two financial entities. On May 11 of that year, the two firms were officially united, resulting in the birth of Shearson Lehman, American Express.
Will remain open late. Now, more than ever, talk with us. Shearson Lehman Brothers, minds over money.
From 1983 to 1990, Peter A. Cohen assumed the roles of CEO and chairman at Shearson Lehman Brothers. During his tenure, he orchestrated a series of strategic moves that shaped the firm's trajectory forever. One of the greatest achievements of this era was the ambitious $1 billion acquisition of E.F. Hutton. This would ultimately lead to the creation of Shearson Lehman Hutton, which expanded the firm's reach and capabilities further, solidifying its position as a prominent player on Wall Street. Significant changes and strategic adaptations for Lehman Brothers came in the 90s under the leadership of Harvey Golub, who was appointed as CEO of American Express. In 1993, American Express initiated a divestiture process, shedding its banking and brokerage operations to refocus its business portfolio. As part of this restructuring effort, American Express made substantial moves in the financial sector. It sold its retail brokerage and asset management operations to Primerica, reshaping its core business functions. Additionally, in 1994, Lehman Brothers Kuhn Loeb underwent a transformation of its own. It was spun off from American Express in an initial public offering, emerging as Lehman Brothers Holdings. The reins of leadership were handed over to Dick Fuld, who assumed the role of CEO after the split. Fold's time in charge of Lehman Brothers was far from straightforward. The 1997 Asian financial crisis and the collapse of the long-term capital management hedge fund in 1998 proved to be huge challenges for Lehman Brothers. Fold's leadership proved to be pivotal in steering the firm through these crises without disaster. The early 2000s proved to be a time of expansion and reinvention for the firm. In 2001, they moved to acquire the private client services business of Cowen & Company. Then, in 2003, Lehman aggressively re-entered the asset management business, a territory it had exited way back in 1989. Starting with $2 billion in assets under management, the firm acquired the Crossroads Group and the fixed income division of Lincoln Capital Management, further enhancing its asset management capabilities. The acquisition of Neuberger Berman also helped build this strategic revival. This realignment, combined with Lehman's private equity business and the PCS business, made up the investment management division, which contributed substantially to the firm's net revenue, totaling approximately $3.1 billion. Then, in 2007, the landscape and entire global economy changed when the subprime mortgage crisis started, the biggest financial crash since the Great Depression. The subprime mortgage crisis, spanning 2007 to 2010, was a seismic financial disaster with far-reaching global repercussions. It was triggered by an ambitious drive for increased homeownership during the early 2000s, prompting lenders to extend mortgages to individuals previously considered high-risk due to shaky credit histories or meager down payments. These riskier borrowers were offered subprime mortgages, carrying higher interest rates to offset the increased lending risk. To mitigate their exposure to this risk, lenders bundled these subprime mortgages into securities, a process known as securitization, and then peddled them to eager investors. This approach was underpinned by the optimistic belief that housing prices would continue their relentless ascent. Indeed, the housing market surged, inflating a housing bubble, particularly in regions with limited housing availability. Home buyers and investors alike anticipated never-ending price hikes, rendering real estate an enticing investment. However, as home prices crested, numerous high-risk borrowers found themselves grappling with unmanageable mortgage payments. Initially, some resorted to selling their homes at a profit or taking out additional loans, but these lifelines dwindled as the market nosedived. Multiple subprime lenders were driven to declare bankruptcy, and securities linked to these precarious mortgages faced downgrades, igniting turmoil in financial markets. As the subprime mortgage crisis unfolded, Dick Fold's leadership at Lehman Brothers faced its biggest test. While CEOs of rival financial institutions like Bear Stearns, Merrill Lynch, and Citigroup were forced to resign, Fold retained his position. Lehman Brothers' board of directors, which included retired CEOs like Christopher Gent of Vodafone and John Akers of IBM, hesitated to challenge Fold, even as the firm's share price continued to decline. By May 2008, prior to its eventual bankruptcy, Lehman Brothers held a substantial $639 billion in assets. To put that into perspective, we hadn't seen a business of this size go under before, and it's something we haven't really seen again since, either. It makes other infamous bankruptcies, like Enron for example, look like child's play. But it was coming. This investment firm, one of the most successful in history, was about to fold. You see, Lehman Brothers had been one of the first Wall Street firms to enter into the mortgage origination business. It started in 1997, when Lehman acquired Aurora Loan Services, a Colorado-based Alta lender. Lehman then went on to purchase West Coast subprime mortgage lender, B&C Mortgage LLC, in 2000. This strategic expansion swiftly transformed Lehman into a formidable player in the subprime market, and during the boom period, helped fuel great success for the firm. The numbers spoke volumes. By 2003, Lehman had extended loans amounting to $18.2 billion, securing a commendable third place in lending. This figure surged to over $40 billion in 2004 and skyrocketed to nearly $50 billion per month by 2006. It's hard to quantify things when the numbers get that big, But that just goes to show the level Lehman was operating at during this period. However, the risk lurking beneath these numbers was also substantial. In 2008, Lehman's assets swelled to $680 billion, but they were precariously supported by a mere $22.5 billion in firm capital. From an equity standpoint, Lehman's high-risk commercial real estate holdings were a staggering 30 times greater than their capital. This meant that a small 3 to 5% dip in real estate values would obliterate all their capital. The implications were dire. Lehman Brothers found themselves teetering on the precipice of financial calamity, their aggressive investments in the real estate market leaving them acutely vulnerable to market fluctuations. Over 150 years of building Lehman Brothers from that store in Alabama into one of the globe's leading financial powerhouses, and the whole thing could be wiped out in an instant. And that's exactly what happened in 2008.
Lehman Brothers is going bankrupt, and financial markets from Asia to Europe are doing their utmost to prevent Monday from turning from dark to black.
The bankruptcy of Lehman Brothers on September 15, 2008, is often billed as the climax of the subprime mortgage crisis, as the crash claimed its largest and most significant victim. Lehman faced imminent catastrophe as it was made aware of an impending credit downgrade, something the firm had been dreading since it became caught up in the crisis a year earlier. In a desperate bid to salvage the sinking ship, the Federal Reserve called upon multiple banks to negotiate financial support for Lehman's restructuring efforts. These talks, however, ended in failure, ultimately leading Lehman Brothers to file a Chapter 11 bankruptcy petition. This bankruptcy filing goes down in history as the largest in the United States, encompassing a staggering $600 billion in assets.
This is going to be one of the watershed days in financial markets history.
It was a manic Monday in the financial markets. The Dow tumbled more than 500 points after two pillars of the street tumbled over the weekend. Lehman Brothers, a 158-year-old firm, filed for bankruptcy.
I don't think anyone really expected.
The fallout from the collapse of Lehman was swift and severe. The Dow Jones Industrial Average plummeted by 4.5% in a single day, marking the most significant drop since the aftermath of 9/11. This market crash shattered any illusion Wall Street and the public had of the government being capable of managing the crisis, and it sent shockwaves throughout the financial landscape, triggering a widespread financial panic and global markets became unstable. The crisis developed further as investors rushed to withdraw from money market mutual funds, a vital source of credit, to avoid the impending losses they knew were surely to come. At the same time, the interbank lending market grew increasingly constricted, meaning that banks on the edge of collapsing began to run out of options. Amid the tumultuous fallout of Lehman Brothers' bankruptcy, in September 2008, a revised proposal emerged on September 22, offering a glimmer of hope for the beleaguered financial giant. The proposal aimed to sell Lehman Brothers' brokerage division as part of the deal. Barclays, a prominent player in the financial sector, stepped forward with a plan to acquire the core business of Lehman Brothers, which notably included the firm's Midtown Manhattan office skyscraper, valued at $960 million. This proposal was presented to the bankruptcy court, and after a marathon 7-hour hearing, Judge James Peck delivered a momentous ruling. "I have to approve this transaction because it is the only available transaction." Lehman Brothers became a victim, in effect the only true icon to fall in a tsunami that has befallen the credit markets. This is the most momentous bankruptcy hearing I've ever sat through. It can never be deemed precedent for future cases. It's hard for me to imagine a similar emergency. The decision to approve the Barclays deal was, in part, due to a lack of viable alternatives. Luc Despins, counsel for the creditors committee, explained, "The reason we're not objecting is really based on the lack of a viable alternative. We did not support the transaction because there had not been enough time to properly review it." Under the revised agreement, Barclays would absorb a substantial $47.4 billion in securities and shoulder $45.5 billion in trading liabilities. Additionally, Barclays would acquire Lehman Brothers' real estate assets, including the iconic New York headquarters, and New Jersey data centers at a price of $1.29 billion. However, Barclays chose not to acquire Lehman's Evil Energy unit, while certain entities like Lehman Brothers Canada Incorporated, Lehman Brothers Sudamerica, Lehman Brothers Uruguay, and the private investment management business for high net worth individuals would become part of the Barclays fold. Lehman Brothers would retain $20 billion of securities assets in Lehman Brothers Incorporated that were not included in the transfer to Barclays. Barclays also faced a potential liability of $2.5 billion, earmarked for severance payments if it decided not to retain some Lehman employees beyond the initially guaranteed 90 days. On the same day, September 22, 2008, Nomura Holdings Incorporated announced its agreement to acquire Lehman Brothers franchise in the Asia-Pacific region, encompassing Japan, Hong Kong, and Australia. The following day, Nomura further signaled its intentions by announcing plans to acquire Lehman Brothers investment banking and equities businesses in Europe and the Middle East too. Several weeks later, it was confirmed that the deal's conditions had been met, and the acquisition became legally effective on Monday, October 13. Notably, in 2007, Lehman Brothers' non-US subsidiaries had contributed to over 50% of the global revenue generated by the firm. As of May 2022, Lehman Brothers Holdings Incorporated, the parent company, remained under liquidation before the bankruptcy court for the Southern District of New York. Caretaker offices, both in the United States and abroad, continued to oversee the disbursement of payments to the company's creditors. This stands as a haunting reminder of one of the most catastrophic financial collapses in modern history. It remains to be seen if a bankruptcy case of this magnitude will ever be seen again. Of course, if there was to be another global financial collapse, it is possible that a firm with more than $600 billion in assets might fall. But given the lessons learned from the collapse of Lehman, this is also unlikely. The story of Lehman Brothers is one that comes full circle, the pursuit of success causing the very nature of the firm to transform and evolve over the 100-plus years it existed, learning from its mistakes and moving away from riskier investments, only to move back to that operation years later in the pursuit of further success. Optimism in the market leading to oversight, and in the end, the fall of a mighty financial institution and something still being felt in walls today.